Hey everybody, I'm here. In the next 6 minutes, I'll walk you through 5 simple, practical ways to start investing with just $100 in 2025. We're gonna keep it real. No jargon, no fluff, just clear advice that beginners can use right now. First, let's address a common fact. You don't need a fortune to begin. Platforms like Webull, Robinhood, Fidelity let you invest with just $100 because they offer fractional shares, meaning you can own part of a stock instead of having to buy a full share. So, number 1. Open an account at a broker that offers fractional shares. Look for one with no fees and a simple app interface. Now, you might be asking why we should invest now rather than later. Well, there's a concept called the power of compounding, which simply put means earning money from your investments. Now, compound interest is often talked about with savings accounts, but it works just as well with investments. Imagine you have $100. If you invest it wisely, let's say at an average annual return of 8%, that $100 turns into $180, then $117, then $126, and so on. Every year you earn more without having to do anything extra. But it all begins with that first $100. So number 2, build a small emergency buffer before investing. The idea is to have some cash ready for unexpected car repairs or medical bills. 3 to 6 months worth of living expenses is what experts suggest, but you don't need huge savings, just enough to sleep well at night. Next, you might wonder how to actually invest this money. After all, you don't want to just hold on to cash, right? So number 3, choose investment vehicles that give you diversification instantly. Your options here are mainly ETFs and robo-advisors. ETFs are baskets of stocks or bonds you can buy like a single stock. For instance, an S&P 500 index ETF owns a slice of all the top 500 US companies, giving you instant diversification. A tech-focused ETF might give you exposure to around 100 of the biggest tech firms. Robo-advisors like Betterment or Wealthfront create and manage a mix of investments for you based on your risk level for a small fee. The key here is to start small, perhaps with $25 a week. This lets you learn without risking too much. But wait. Isn't investing risky in itself? Well, yes, it is. Markets go up and down. That's why our next step is number 4. Use dollar cost averaging. That means investing the same amount each week or month, like $25. When markets are high, you buy fewer shares. But when prices drop, you get more shares for the same price. It's a simple strategy, but it's effective. By consistently investing, you avoid putting all your money in at once, which could be risky. Plus, you lock in a good price every time. Over time, dollar cost averaging smooths out the ups and downs of the market and helps you build wealth steadily. Let's talk about how to actually allocate your money. After all, where should you be putting your $100? So number 5, consider different asset types, but keep it simple. You can divide your $100 like this. $40 in a broad US index ETF, $30 in a global or emerging markets ETF, $20 in a clean energy or biotech ETF, and $10 toward a Bitcoin ETF or fractional crypto for very small exposure. This mix covers the main opportunities: home-based stability, global growth, innovation, and a bit of high risk, high reward. Later, as you become more confident, you can adjust this mix based on your needs and goals. So to recap everything: open a fractional share account, build a safety buffer, pick low-cost diversified ETFs, or a robo-advisor, use regular contributions, spread your money smartly, rebalance, and stay disciplined. There's no one-size-fits-all approach to investing, but these steps offer a solid starting point for anyone looking to grow their wealth in 2025. Let's discuss the ins and outs of each step further. So the first step is to open a fractional share account. This allows you to invest in portions of shares, making it possible to start investing even with a limited budget like $100. Many online brokerages offer fractional shares, including popular platforms like Robinhood, Webull, and Moomoo. Each platform has its pros and cons in terms of fees, available investments, and user experience. It's important to research and choose a reputable platform that aligns with your investment goals and preferences. The second step is to build a small emergency buffer before investing. Having an emergency fund is crucial to ensure you're prepared for unexpected expenses or financial setbacks. While investing is a great way to grow your wealth, it's essential not to dip into your investments during tough times. The recommended amount for an emergency fund is 3 to 6 months' worth of living expenses. However, even having 1 month's worth of expenses can be a good starting point. The third step is to choose investment vehicles that give you diversification instantly. Diversification is a key strategy to manage risk and potentially increase returns. By spreading your investments across different asset classes, industries, and geographic regions, you can reduce the impact of any single investment's performance on your overall portfolio. This helps you stay invested for the long term without being overly affected by short-term market fluctuations. Two popular options for instant diversification are exchange-traded funds, ETFs, and robo-advisors. ETFs are investment funds that trade on stock markets and typically consist of a variety of securities such as stocks, bonds, or other assets. They allow you to invest in a wide range of investments with a single purchase. Robo-advisors are digital investment platforms that use algorithms and computer-driven technology to create and manage investment portfolios for clients. They often have lower fees compared to traditional financial advisors and can provide a more hands-off approach to investing. The fourth step is to use dollar-cost averaging. Dollar-cost averaging, DCA, is an investment strategy where you buy a fixed amount of an investment at regular intervals regardless of the current market conditions. This approach allows you to take advantage of both high and low market conditions over time, potentially reducing the impact of market volatility on your investment returns. DCA can also help you stay disciplined and avoid making emotional investment decisions based on market fluctuations. The fifth step is to consider different asset types, but keep it simple. Asset allocation is an essential part of building a well-balanced investment portfolio. It involves dividing your investments among different asset classes such as stocks, bonds, and cash to create a mix that aligns with your risk tolerance and financial goals. Stocks represent ownership in a company and have the potential for high growth, but also come with higher risk. Bonds are loans you make to governments or corporations in exchange for regular interest payments and typically have less risk than stocks. Cash includes savings accounts, money market accounts, and certificates of deposit, CDs, providing stability and liquidity to your portfolio. By diversifying your investments across asset classes, you can mitigate risk and potentially enhance returns. Starting with just $100, it's important to keep things simple and focus on building a solid foundation. Consider low-cost broad market index funds, such as those tracking the S&P 500 or the Dow Jones Industrial Average, as they provide instant diversification and have historically delivered strong long-term returns. Additionally, explore international ETFs to gain exposure to global markets and emerging economies. These funds allow you to invest in a wide range of foreign stocks and bonds, helping you diversify beyond your home country's economy. Thank you so much for watching. If you enjoyed this video, please hit the like button and subscribe for more informative content. If you have any questions or comments, feel free to drop them below. I'd love to hear from you. Thanks again for tuning in, and I look forward to seeing you in the next one.